Welcome back. We are watching a market sell-off this morning. We just got a hotter-than-expected producer price index, up 0.5% month-to-month and up 2.9% year-to-year. The International Monetary Fund says the U.S. economy is, quote, buoyant, with growth expected to accelerate to up 2.4% this year. The IMF also says unemployment should remain close to 4% and that inflation moves toward the Fed's 2% target. The fund crediting strong productivity in America and resilient demand for supporting that outlook, while warning rising federal debt is becoming a growing stability risk. U.S. third-quarter productivity was a boom, surging at the fastest rate in 2 years at 4.9%. Joining me right now is the leader of the International Monetary Fund, Managing Director, Kristalina Georgieva, is with me right now. Kristalina, it's wonderful to have you. Welcome back to the program.
Thank you, Maria. Great to be with you.
And I want to talk with you about your Article 4 consultation mission, where you were able to speak and had meetings with Secretary Scott Bessent and Federal Reserve Chairman Jay Powell. I want to hear more about that and what came out of that talk, particularly regarding productivity in America. But first, give us your reaction to the PPI number that we just saw, which has caused a market sell-off.
What we have seen over the last year is inflation trending down. This is a sidestep, but in our view, this trend will continue. We expect inflation to fall to the Fed's 2% target by early 2027. Where inflation has dropped faster is in services, a little bit slower in goods. But I think we should keep our eye on the longer-term trend, and it is for inflation to go down to the Fed's target. Of course, the Fed needs to monitor developments very closely to make the right decisions when time comes.
Yes, this is a very important point that you make in terms of where things have been headed and the trend that we're seeing. Kristalina, you just came off of your Article 4 consultation mission in terms of your assessment after having your conversations with leaders across the world. What can you tell us about productivity right now?
Well, let me start by saying that the performance of the U.S. economy in 2025 was very strong, and in 26 we expect it to get even stronger. Growth last year in the U.S. 2.2%. This is 0.5 percentage point higher than the rest of advanced economies. And you're right to point to productivity, because what is phenomenal about the United States is that strong growth is anchored in productivity growth. And in that sense, the U.S. is a positive outlier. Most of the rest of the world has been struggling to see productivity going up, but not the United States. And why is productivity in the U.S. so strong? Well, first, because of the innovative nature of U.S. businesses. In 2025, the hero was the American entrepreneur and the American worker, because of the dynamism they bring to the economy. We see the technological diffusion in the United States going much faster. Capital in the United States is not just abundant, but it is more willing to take risk than capital in the rest of the world. And then in the United States, the state has moved further away from interfering in the economy, and this cutting of red tape is also helping productivity to go up. And what is also very impressive is how widespread productivity gains are. They are in financial services, they are in logistics, they are in retail, they are in healthcare, and that makes the United States virtually the productivity leader of the world.
Yeah, that's very important. And there's you say that there's an upside risk that this technology investment flow and the administration's focus on cutting red tape will bear fruit, and they'll support greater economic dynamism. We've been talking about that dynamism all morning. AI and these new technologies reshaping the future of work, helping to boost productivity. But the IMF is also estimating that around 40% of jobs worldwide could be affected by AI. some roles enhanced, other roles eliminated. Which brings me to the story of the morning. Jack Dorsey's fintech company, Block, announced plans to cut 40% of its workforce. That's 4,000 employees due to new tools, AI tools, that will replace human work. So, Kristalina, tell us a little about that, because you just mentioned technology, and we know that AI has already boosted the economic-wide productivity story. While we're seeing the positive effects of AI on productivity, what should we understand better about the impact on jobs?
So we actually looked into what is happening in the job market. And yes, already 1 in 10 jobs require new skills, AI-related skills. But these jobs also pay better. And people with more money in their pockets, they demand more services. They go more to restaurants, to sports, to entertainment. So what we actually observed is that the total amount of jobs not only hasn't shrunk, but it actually increased a little in that area, in services. So what is our conclusion? Big changes are happening in the labor market. We have to be prepared for that, and we have to look at how we can support people moving from areas where jobs are shrinking to areas where they are expanding, so we can have the balance in the right direction. Actually, we expect unemployment in the United States to stay around 4%. This, as you know, is full employment. Because of this redistribution, some jobs indeed are either changing dramatically or disappearing altogether. But don't forget, people have more money in their pocket, they spend more. One thing that we have observed is that the consumer in the United States remains quite resilient, and it is because of the improvements also in income levels we have seen over the last year.
Yeah, and in fact, we're just learning this morning that OpenAI have announced $110 billion in new investments from companies such as SoftBank, NVIDIA, and Amazon. OpenAI raised $110 billion at a $730 billion valuation, partly because of this new $50 billion investment from Amazon. You've warned that AI could disrupt the global labor market like a tsunami, but you also just mentioned that there are certain sectors where we'll see different jobs. Can you tell us about the jobs and the sectors that you think are most affected? Because I know that over the last several years, we've needed millions of new nurses. We've needed more, trade school opportunities like electricians. And you just mentioned financial services as well.
So what we can see, and of course, this is fast-moving subject, Maria, but what we can see is that services are expanding and job opportunities in services are growing. What is most concerning is jobs that normally would be entry-level that can be automated in companies. And when they disappear, for young people, it becomes harder to find their first job. And that, I think, is important to recognize, that people have to now learn and be much more agile and adaptable in the labor market because of the changes that are coming. But let me say one thing about the United States.
Yes.
In the US, there is phenomenal growth of new companies that come with jobs that we cannot even imagine.
That's right.
And that very rapid growth of new companies that we don't see in the rest of the world gives me more comfort that yes, there will be tremendous change in the job market, but there will be jobs for people with the creativity, the dynamism that we see in this country.
This is such a great point, and we've had Paul Atkins, the SEC chairman, on this program talking about just that, trying to get IPOs and companies to come out with more opportunities. Real quick, Kristalina, we have to jump, but is there any country out there, you've looked at all of them, is there any country that competes with the U.S. when it comes to this productivity boom right now?
No, the U.S. is on the frontier of innovation, creativity, and dynamism in the private sector. And we tell the rest of the world, look at the U.S. private sector in a rapidly changing world is your best bet.
Kristalina, great to have you. Thank you so much for that breaking news. IMF Managing Director Kristalina Georgieva. We'll be right back.